a biannual, actually, it's every 2 years FUJCon, which is a gathering of all of the key bunkering stakeholders in the east of Suez market. And it's certainly an important timing for that, given all the dramas that have impacted the markets over recent days. And shipping is sort of at the forefront, bunkering at the forefront of all of the new lower carbon requirements. And so a lot of chatter around where those two intersects, global trade war and continued energy transition. Meanwhile, the oil markets seem to have taken a pause from their knife through butter, their rock through water, whatever the analogy one wants to jump on, that we've seen in the last week. Oil prices trading up 0.5% this morning in Asian trade, a little under $65 a barrel. Let's welcome David Fife to the table to kick us off this morning. David, your thoughts on this sort of crazy week we've been in. What's the main driver behind this oil price collapse, and what's giving it pause for concern today?
Well, good morning, first of all, and thank you for having me on the podcast. Two key elements from last week. Obviously, we had the announcement of higher than expected tariffs from the Trump administration, and that has raised a whole lot of concerns about the strength of oil demand, the potential for a US, if not a global, economic recession. But equally importantly for crude last week, I think, was the announcement from OPEC Plus that they were going to accelerate some of the tapering of supply cuts and push back another 400 kbd plus in May onto the market. And the juxtaposition of those two really had, I think, some traders scratching their head around the timing of the OPEC Plus announcement. So those are the two key drivers. And obviously, critical for the way ahead, I think, is whether you perceive Trump's tariff deployment to be a negotiating ploy on one hand, in which case we may dodge the bullet of recession, or whether it really is about reshaping the US industrial base and is likely to be more long-standing. And that's critical for people's perception of where price and oil demand go from here.
Let's welcome Michelle Weiss-Buchmann, independent maritime and energy commodities analyst. Michelle, your thoughts, again, same question. I mean, I'm hearing over the last few days, and again here at this FUJCon conference in Fujairah, that we're looking at a historic inflection point, that this is, despite the language, let's say, that the Fed chairman used, inflation may be temporary, but that this is a reconfiguration, a historic reconfiguration of the trading markets. I mean, they mentioned there, is this a negotiating ploy? In some ways, it feels like it's kind of irrelevant, that question, because ultimately the damage is done. The genie's out of the bottle. The glass is broken. The milk is spilt. Whatever is your preferred analogy. Ultimately, Michelle, your thoughts on the intersection of this this decision by the U.S. administration, long signaled but delivered a much bigger sort of dramatic scale than anticipated. If this is historic, if this is an inflection point, do we see any of that reflected in shipping? Where does shipping get impacted by all of this?
Oh, good morning, Sean. Well, just so many things affected against this backdrop. Of course, you have the G7 tariffs on Russia. Urals crude is now well below $60 a barrel. So effectively, the price cap is no longer working. We're already seeing private Greek ship owners taking crude cargoes and shipping them around the Cape of Good Hope. They're not going through the Red Sea yet to India. So you're having that recalibration. Against the oil price shock, you've also got the threat of China made ships having tariffs imposed upon them when they call in the US. That's also recalibrating tanker markets. Now, longer term charters are being redrawn, and Chinese built ships are now having a discount in chartering. We've got the maximum pressure campaign on Iran, thought to be a bullish impact on oil prices, and now really the only remaining, I think, bullish impact on oil prices. And yet we're seeing in March we had record yet again Chinese imports of Iranian oil, and still no sort of impact to maximum pressure. So there's just so many things in addition to this price route that we've seen at the moment.
Let's welcome Osama Rizvi, energy and economic analyst at Primary Vision in Pakistan. Osama, how is this all landing in Pakistan? I didn't, in the long list of countries who got whacked by the Trump tariffs, how Pakistan fared on that list. But ultimately, like many sort of trade wars and others, that the more developing emerging economies get hit the most. How is it landing in Pakistan?
Well, Sean, Pakistan was indeed one of the countries that got around 29% of tariff, reciprocal tariff, plus the 10% baseline tariff. And interestingly, Pakistan has a trade surplus with the US to the tune of $5.3 billion or something like that. In Pakistan, which is already facing a lot of issues in terms of its exports because of some domestic and international issues, certain sectors are going to feel the pain or feel the pinch of these tariffs. For instance, synthetic apparel already had a 33% tariff rate or customs duty. And when you put that and you plus the recent one, it goes beyond 60%. And textile industry in Pakistan is responsible for more than 65% of Pakistan's total exports. So there is a lot of meetings. I mean, even in the morning today, there was a meeting where 50 top exporters and the industrialists of Pakistan met the Prime Minister. They are trying to initiate talks with the US. Actually, Marco Rubio and our economic minister also spoke today regarding the tariffs, immigration, and build more projects on critical minerals. So I think there's a lot going on. Pakistan has, a huge stake in it, given the country's precarious economic situation that has been going on for the past 2 years. And time will tell, but it's actually paradoxical. On the other hand, lower oil prices is going to help the country. But then, it's about the weightage. So lower oil prices, but the export sector gets hit. So we'll have to wait and watch.
David, just coming back to your earlier point here, we've got sort of two drivers in the last week of the sort of declining everything price. The financial markets, equity markets, quite spectacularly down 20% in bear market. The oil price, down about 15% in the last week or so. But David, you mentioned the sort of two drivers, the tariffs and the OPEC Plus decision. If we could separate those two, Dave, and say, what's do you think behind the OPEC Plus thinking? Because it seems to be a significant departure from the last few years of balancing the market and kind of maximizing price on the back of that. What's driving this, which clearly, although OPEC haven't overtly come out and said it, they'd be hard pressed to present an argument that they're balancing the market by accelerating oil supply increases. So I'm just wondering, what's your thoughts? What's the logic, if you can identify behind this decision of OPEC Plus?
Yeah, obviously this is speculation, but two potential drivers there. One is to try and send a signal to the habitual overproducers within the group that if you don't get your house in order and follow through with compensatory cuts, we're going to have extra barrels on the market from those of us, the voluntary cutters, if you like, and we're going to push some extra barrels into the market in May. So it may have been a shot across the bows to some of the overproducers. The second point may well be that it's simply trying to push some barrels back out into the market while they can, before there is a major hit to oil demand. As I said, we will be this month reducing our global GDP estimates and cutting our oil demand estimates for 2025. The big question is by how much? And I'm sure the OPEC plus grouping is looking at that as well. So it's a little bit of a safety valve, if you like, for people who've been sitting on production, holding in, restraining production for many, many, many months. And there may be a sense of let's push some extra barrels out onto the market while we can, without cratering or without generating a massive surplus of stocks.
Michelle, just picking up on the analogy, the historic scale of this thing, and one has to take it on face value. Trump's been, the most important thing I think always to remember at these times, quite often Trump administration and President Trump gets sort of dismissed as ad hoc, as, shooting from the hip on a daily basis. But actually on tariffs, he's been parroting the same point for 40 years, that this idea that the US has been, quote unquote, being ripped off by all of its trading partners. And so this is a long-term, deep held ideology of this new of the returning president, and not a temporary moment. And so taking the historic sense of he's taking the opportunity to implement this historic and long-held view of his, how could we see that be reflected in shipping? We're seeing every market drop? Are we seeing shipping rates drop? Are we seeing, will we start to see trading volumes decline? Where do you see this playing out on the high seas, so to speak?
Well, counterintuitively, when oil demand falls, usually tanker rates, especially for very large crude carriers, the largest tankers, will rise. And that's simply because China is very price sensitive and usually increases their exports.
Their imports.
Sorry. Yeah. So far, amidst all the chaos of the last 3 or 4 weeks, we've actually seen tanker rates rise. Aframaxes, which are the smaller tankers used for Russian trades, their rates have increased because of the sanctions crackdown, which means that there are fewer tankers available for shipments. So at this point, it's been reasonably positive, but of course that could all turn very quickly depending on how trade recalibrates. For example, when we come to LPG, China is reliant on the US for most of its ethane, about half of its LPG. Will they impose tariffs on that? Will that recalibrate gas markets there? Will there be any retaliatory tariffs on US exports of oil? We just don't know at the moment. And of course,
it seems that the China particular piece, there is an escalatory frame. I think there's sort of ultimatums. Trump has given 50% more. It's unlikely the Chinese will blink in the front of an ultimatum, and this sort of just continues to spiral.
Indeed. So, of course, we also are looking at other factors that affect shipping. There's the Red Sea area. If there is we note that overnight we heard that Donald Trump's going to reinstate talks with Iran on the nuclear question. Will that impact the Houthis? And
on the Houthis point, we saw in recent weeks, obviously, we're going to blow the Houthis back to the Stone Age, and it's kind of certainly gone off the headlines. Has the impact changed? Have the Houthis relented? Is there more traffic going through the Red Sea?
No, that situation is still quite fragile. And I think on the whole, although we've seen a few LNG shipments, it's been very, very minimal. I think we can say that it's very stable, and that as I said earlier, Greek ship owners that are routing oil cargoes from Russia are going around the Cape. Previously, those cargoes would have gone through the Red Sea because they would have gone on dark fleet ships. So for the moment, I would say that until there's a more definitive peace process, that situation will remain.
Osama, just looking a little bit wider than Pakistan into the Asia as a whole, we saw reports yesterday that Asian oil imports in the first quarter as a total number were down 600,000 barrels on a year ago levels. Generally, this moment of sort of global trade war is happening into what is already a weak economic frame in Asia. How do you think this moves from here through the course of this year, a year in which, like any other year, Asian oil demand growth was expected to be the sort of anchor of global oil demand growth? That may disappear fast. Your thoughts?
Well, that's very interesting because there has been a lot of talk about what will be the impact of these tariffs, specifically on oil and gas markets, right? So far, it seems the product market and the crude oil has been, exempted from this. But if we look closely, the tariffs target the countries, specifically in Southeast Asia and Far East, that was supposed to be the source of demand for the next 10 years when it comes to oil. So we were talking about Vietnam, where we saw an economic miracle, 7% plus economic growth. We're talking about other countries. So I think while there is not a direct impact on this, despite lower prices, I believe, and as you mentioned, given the current economic environment, the demand is going to suffer. Now, we also need to look at what is happening in China. Recent economic data coming out of China indicates some positive activity. And China has been really ramping up their oil imports as well. And now they have a lot saved in inventories. We discussed this before as well. So when the next figures come for the next quarters or for the next month, I believe that is going to further dampen the sentiment in the oil markets. And I see a lower for longer oil price. And I see Asia, including South Asia, my country, Pakistan, going to face a lot of issues, specifically in regards of uncertainty regarding the global economic order. It's totally uncertain.
On the uncertainty, but also pick up on that in the context, Osama, of this as a historic moment. Is that something you would share, or is it just another blip, and it too will pass? I mean, from an Asia, from a Pakistan point of view, from an India point of view, best buddies with Trump and Modi, and they still got I think a 30% tariff whack. What does this look and feel like from a sort of a shifting point, and what would be the alternatives? Are we going to see a deeper engagement with the BRICS, for example?
Yes, so, a wonderful question. I believe nothing that has happened or eventuated in the previous few months, specifically, or post-pandemic, can be said that this too shall pass, because all of that has been significant, highly significant, that one way or the other spill into the overall structural changes happening in the global economic order. You see the enterprise of sanctions not working to the extent as it used to, because Russia's oil revenue essentially remained the same or dropped only slightly. You see that the flow of hydrocarbons started to stopped going to west, but then Asian markets accepted it with arms wide open. We have also seen Pakistan and other countries now focusing on what is called the multi-vector foreign policy, because the suspension of US aid, this uncertainty, the student visas, people go a lot of people from Pakistan want to go to US, but now I meet a lot of people here. I'm engaged with the business of education in terms of speaking to students. Nobody wants to do that, Sean. They're looking for China. They're looking for Central Asia. Actually, Central Asia is a very good destination these days, very famous amongst Pakistanis. So there is a structural shift happening. And I think BRICS and China as a whole, they stand to gain a lot from this, because, in international relations, there can't be a vacuum, and it needs to be filled. It will be filled with China and BRICS.
Let's go to the survey question, which is trying to get at the angle of, what will stop oil prices from falling further. And it seems that they've stopped today for the time being. There is a pause on this rock through water decline of the last week. Is this a temporary moment before a further decline? I was just recounting yesterday that the last time we saw such a significant sort of contrarian position by OPEC Plus 25 years ago, increasing supply into the Asian financial currency crisis in the late 90s, and the demand collapse, and the oil price fell to under $10 a barrel at that time. Now, of course, it was falling from a much lower point. I think it was a $20 high back in 98 and then dropped to below 10. Now, of course, we're dropping from 70, but could we see a similar proportion? It fell at that time half its value. Could it lose half its value on this occasion? What will stop oil prices from falling further? OPEC abandoned supply increases, OPEC Plus abandoned supply increases. David indicated there that they're getting these increases in before they have to essentially retrench because demand collapses. Trump abandons the tariff war. Is this just a negotiating ploy by Trump? And this will, we'll wake up on Monday morning and it'll go, I've changed my mind. I want to look at a different shiny object this week. Iran sanctions. Michelle mentioned that the Iran sanctions remain one of the more bullish potential for oil markets if indeed Trump manages to lock them in, to lock oil exports in Iran. So a non-OPEC plus cut production, the US, Guyana, deep offshore, Brazil, all of the new supply coming from there ends up being stopped or temporarily reversed. Which of these four acts as a sort of foundation or a floor for this oil market, do you think? Welcome your thoughts on that. Dave, just picking up on that question, your thoughts, the pause we're seeing in the oil markets today, is this a timeout from what has been a sort of a shock and awe moment, or have we seen something come in to create a floor?
I think it's a little bit of a bounce after a couple of days of very, very heavy falls, and that's not unusual by and of itself. The market is trying to digest how serious Trump is around these tariffs. And I mean, you painted a picture just now of something that was fairly binary, that he wakes up one morning and says, oh no, this was a terrible mistake. I don't think he's going to do that. I think what we may see is the emergence of a number of negotiations with key trading partners that tries to lower tariffs on both sides. And I think if the market sees evidence of that, it could begin to have a little bit of faith that the US and the global economies swerve an outright recession. I don't think there's any doubt that what the damage that has already been done, the choking off of investment, the reticence that consumers are going to have in the face of rising prices, which will be an inevitable upshot of tariffs, that is going to see an economic slowdown. The question is, from Trump's perspective, how long does he keep punching himself in the face, both in terms of the economic pain that this does to the US, but also some of the political pressure that he's going to come under. And remember, we're less than 2 years from US midterm elections. There are noises off. Now, he traditionally has not necessarily listened to those noises off. But if there is a clamor from the Republican side of the aisle that this is doing damage, it may well encourage him to sit down with some of the US's trade partners.
Certainly, you're hearing the billionaire class. A very strong interview yesterday with the CEO of Home Depot, which buys a lot of stuff from Vietnam, and he is not happy, and many others who are running massive businesses. Michelle, I wanted to get your thoughts on the same question. Is this a floor we're seeing come into play today, or temporary pause? And you mentioned there earlier in your commentary that we at these price levels were below the price cap sanctions on Russian oil. Does that open up the gateway for more Russian oil? Of course, they're also confined by OPEC quotas.
I don't think so. I think that, Russia is exporting all, at current levels that it can. But I think we also have to throw into the mix here profitability levels for shale producers in the US Gulf. And of course, that's about $60 a barrel level. And I think there will be pressure from oil producers to the Trump administration, which overnight was obviously lauding the benefits of cheap gasoline at the pump for US consumers. But ultimately, if we go back 5 years at the beginning of the pandemic, and we remember the damage that was done to that industry when oil prices fell and demand dropped off a cliff because of the pandemic. So I think we can look back and see that is also going to be something that will pressure the Trump administration in, I would say, coming weeks, especially if this oil price remains at current levels. I think it is actually around $60 a barrel. So things are going to get very serious very quickly for those producers.
And of course, the shale industry is ironically widely regarded as kind of manufacturing of oil. And it is an industry that is all American. And you're thinking, well, if we want to make a manufacturing industry in America, well, you have one, and you're kind of potentially killing it or giving it a good kick in the shins. Osama, last thought to you on this basic question. Do you see today's price decline pause as a floor? We've reached some kind of floor here, or is there more pain in this?
Well, Sean, I have always been bearish on oil prices and oil markets. This was only a trigger. I mean, things were set for this correction. When we look at the global oil stocks, especially gasoline and diesel, that directly corresponds to manufacturing. Manufacturing in the US has been down. We all know that. In the Europe, it has energy-intensive manufacturing has also been down. And this also relates to my point that all of the story of oil for this year will be the story of oil supply. And in that regard, the US shale stands out. And at Primary Vision, we have been tracking oil supply in terms of the frac job count that also corresponds to the direct jobs being performed. Interestingly, so far, while the frac spread count and rigs have gone down, the frac job count as compared to the previous year have stayed stable. So, I mean, the actual number of completions are still the same, almost the same when compared to the last year. Now, the Dallas Fed Energy Survey do highlight some rising uncertainty and operating margins falling down. So if oil prices do not halt, at this level and go beyond 60 and well into the lower 50s, which is a possibility actually, then we can start to see, considerable significant slowdown in shale, not before that.
Well, we'll have to wrap it up there. Interesting on some of these questions we heard this morning at the S&P Global Commodity Insights Platts Forum here in Fujairah, that they expect oil prices, Brent, to still average in the low 70s this year, even despite the traumas in the global trade war that we're currently seeing. At least that's how they're digesting the current data as much as one can. They also said they expect OPEC Plus to back away from the supply increases in the second half of the year, a bit of echoing some of the comments that Dave said there, that they're kind of grabbing a window to increase, but inevitably will have to retrench later in the year as the sort of demand collapse that could be, that we went into this sort of period, the first quarter, with a general understanding that global demand growth for 2025 was going to be about 1 to 1.5 million barrels a day. That was kind of the range from most analysts and research houses. Now there's a recalibration, as Dave mentioned. They're doing it themselves. Others will be doing the same. What we'll see numbers start to emerge that demand growth for 2025 could be closer to under a million, and maybe in some cases well under a million. So once those data points start to drop, it'll obviously have a big impact on the direction of travel. But for now, Brent crude oil has taken a pause. It is up 0.5%, still under $65 on Brent. And in terms of our survey question here, what will stop oil prices from falling further? OPEC abandoning supply increases, Trump abandoning tariffs. Both of those things seem very unlikely in the immediate short term. But as we say, one can wake up any Monday morning and the world can change. So thank you so much to all of our three guests this morning. Dave Fife, Osama Rizvi, and Michelle Bachmann. Really great to have your insights as always. Have a great day and all the best.
Thank you.
Thank you.